Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Seana Smith. Let's get you the three things that you need to know today. First up, U.S. stock futures fluctuating this morning amid the latest econ data and also the latest commentary from Commerce Secretary Howard Lutnick on tariffs. Now, Lutnick saying that the Trump administration may announce some relief on Mexico and Canada as soon as today. Auto stocks getting a boost. You have GM and Ford leading this morning's gains. Possible reduction on tariffs providing some relief here for investors. Now, this coming after the S&P 500 wiped out all of its post-election gains in yesterday's trade. The index has seen back-to-back losses of more than 1%. That's the first time that we've seen that degree of selling here since December. And despite the sell-off, President Trump defending his use of tariffs in a joint address to Congress, he warned that there could be some economic discomfort ahead.
Tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly. There'll be a little disturbance.
The president went on to announce reciprocal tariffs that are set to come on April 2nd. He also weighed in on the CHIPS Act, calling for an end to the $52 billion subsidy program. And on the economic front, ADP payroll is seeing the slowest pace of hiring since July. Private sector adding just 77,000 jobs in February. That was well below the expectations for 140,000. Now, the latest economic figures adding to other recent data pointing to a slowdown in the labor market ahead of the all-important jobs report this Friday. So if you're waking up right now, you've got a lot to digest here this morning. You're taking a look at a mixed picture here, I guess a bit not too far from the flat line for the three major averages as investors digest the latest commentary from Commerce Secretary Howard Lutnick signaling maybe we could see some reduction, some sort of compromise on tariffs with Canada and Mexico. And then, of course, you square that with a weakening jobs market. We got the latest ADP print out this morning. We saw only 77,000 jobs added to the U.S. economy. That was well below the expectation of 140,000. Here to help us make sense of all this, we have our very own Josh Schaefer. And Josh, it is a lot to digest here for investors, just trying to gain some sort of frame of reference here for how these next couple of days are going to go.
Yeah, definitely. I mean,
or even hours.
It seems like the takeaway, at least from the last 24 hours on tariffs, is we're getting some sort of tariffs here. Maybe it won't be as bad as feared, but tariffs are likely coming, maybe somewhere in that middle ground. But it didn't seem like the market really cared too much about that during that Lutnick interview, Seana. It seemed like we actually saw futures move down. Again, you mentioned ADP private payrolls also came out at the same time. Not a great sign there. 70,000 or 77,000 private payrolls added, largest decrease from the month prior, seen in about a year. So a pretty big slowdown. And within that, what I thought was interesting from the economic data front, ADP chief economist Neil Richardson saying policy uncertainty and a slowdown in consumer spending might have led to layoffs or a slowdown in hiring last month. So policy uncertainty, one peg there, and then also just a general slowdown that we've been seeing in the data also contributing to the concerns here. And it feels like all of this coming together to just create more cloud over the economic picture, and it doesn't seem like we've had a lot of good news on that front in the last couple of weeks.
Yeah, and how worrisome is that for the market, especially when you take into account that we're not too far from those all-time highs?
No, we're not too far, but we're not as close as we were 2 weeks ago, right? Yeah. And I think that's part of what I'm taking from the market action today. As you mentioned, I believe we just had back-to-back 1% down days, first time in a long time that we've seen that. Mm-hmm. So you already kind of started to price in the reality of tariffs, I think, over the last couple of days. So to see the market sort of flat right now, I think kind of makes sense to me. I think we've done that pricing over the last several days. Same on the economic data front. ADP isn't usually a big market mover because we have the jobs report coming on Friday from the BLS, and people like to follow that a little bit more. But it's just another pin in the economic slowdown story. And so it seems like another thing that's adding to it, and then maybe we wait for Friday to see if we get any sort of comfort.
Yeah, exactly. And then when we try to figure out how tariffs and the threat of even more tariffs down the line, when we talk about the reciprocal tariffs that could go into effect on April 2nd, lots of questions even about what the tariffs are going to end up looking like here with Mexico and Canada and how long they could potentially be in place for. I guess the question is how much of that is going to contribute to that slowing narrative story, or how much of that was already underway, just given all of the data and given even the sentiment numbers that we've seen here over the last couple of
months.
I
mean, you've seen weaker data that is related to tariffs and weaker data that may or may not be related to tariffs, right? And it seems like there's perhaps some pull forward that was happening and maybe the ISM manufacturing data and some other data points. But overall, I do think there was a little bit of just the slowdown might have already been happening from a consumer standpoint. And that was something that Neela Richardson pointed out on the call to me when I was speaking with her about 25 minutes ago. She said, well, if you look at where some of the hiring was weak and where there was just slowing in the labor market, it matches the slowing retail spending and the slowing consumer spending. And to her, that makes the consumer overall, whether it be how they're reacting to tariffs and digesting that, or just where they're at financially right now and how wages are increasing and where the inflation picture moves those consumers, is going to be the key moving forward, because again, this is a consumer-driven economy. We can talk about tariffs till the cows go home, but it doesn't matter unless consumers stop spending less, right? The consumers are sort of at the key here, and the labor market is at the key here, and now tariffs could hurt both of those. But if people have money, or if people have jobs and then they have money, they can continue to spend, and the economy would keep moving, maybe at a slower pace than we thought, but it would keep moving. So the consumer still remaining sort of the key here as we're thinking about all of this.
Yeah, certainly. I guess you can, sum it up, and it introduces another degree of uncertainty, and I guess the extent of that is very much.
Uncertainty is the word of the month.
It is. Some word I feel like I've been using way too much lately for a lot longer than a month. All right, Josh, great stuff. Thanks. In an address on Tuesday to Congress, President Trump touting his efforts to remake America's economy, acknowledging Americans could feel near-term pain for ongoing tariffs.
Among my very highest priorities is to rescue our economy and get dramatic and immediate relief to working families. As you know, we inherited from the last administration an economic catastrophe and an inflation nightmare. As president, I'm fighting every day to reverse this damage and make America affordable again. Other countries have used tariffs against us for decades, and now it's our turn to start using them against those other countries. Tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly. There'll be a little disturbance, but
Commerce Secretary Howard Lutnick offering some relief maybe to markets this morning, saying that President Trump will, quote, probably reduce tariffs on Mexico and Canada later on this afternoon. We're seeing some of that reflected in the pre-market action here this morning. Joining us now, we want to bring in Jason Furman. He's a professor at the Harvard Kennedy School of Government, also a former Council of Economic Advisors chairman under President Obama. Jason, it's great to have you back here on Yahoo Finance. I guess let's just start with the whipsaw action, I think it's fair to say, out of Washington here over the last couple of days. Just what's your assessment of some of these tariffs that have been announced, and then the threat of reciprocal tariffs as you look ahead to next month?
Yeah, it's just really extraordinary. I mean, the one fixed point for Donald Trump is he loves tariffs. The reasons he loves them keep changing. The countries change. The magnitude of them change. But those love of tariffs, that's the one thing that there's no whipsawing on. It keeps being the same.
What do you see as the economic consequences of these tariffs? And obviously there's so much unknown at this point, just in terms of what they're going to look like, whether or not we're going to see any sort of reduction in the tariffs that have been announced on Canada and Mexico. But how big of a threat is it to the U.S. economy?
It depends on the magnitude of the tariffs and their duration. The impact is definitely negative. There's no doubt about that. More inflation makes it harder for our exporters, so harder to add jobs, bad for growth. All of that goes in the same direction. How big it is depends on how much. Canada and Mexico, even a 10% tariff across the board that was sustained would be very disruptive to one of the most successful integrated markets in the world.
Is there a threat of a recession there, Jason?
I don't think for the United States. For Canada, there might be, by the way. And one thing the president's right about is there is some asymmetry here. The United States matters more to Canada than Canada does to the United States. So for us, you're talking about slower growth. And then we'll see how the Fed responds. If you get more inflation, do they say we need to raise rates or hold off on rate cuts? Or do they get nervous enough about the real economy that they cut rates? And, last time around with the big tariffs in 2018, 2019, they cut rates. This time, I don't think they're going to be so quick to rescue the economy.
Jason, what's the biggest lesson that you're taking away here from the last several days, and really what we've seen over the first month and a half of the Trump administration, just in terms of the approach right now to global trade and the follow-through that we've seen on some of the tariffs?
Look, the president's economic advisors are not in charge. They had very different ideas. The stock market is not in charge. The president's not talking about it anymore. In fact, he's talking about the bond market. where yields are falling largely because the economy is slowing and nervous investors are fleeing to safety. So the person who's in charge right now is Donald Trump. He's making these decisions, and his whims change from moment to moment. But those whims are really about the details. The fundamentals are staying the same, and it's disengagement of the United States from the global economy.
Jason, let's talk a little bit more about just the market and comparing that to the weakening economy that we are seeing. Yes, we have seen a bit of a pullback here in stocks as of late, but we're not too far from those record highs that we hit not too long ago. I guess, how do you reconcile the market still at the levels that it's currently at, comparing that to the threats coming out of DC, tariffs that have been introduced, and then coupling that with the weakening econ data that we have been getting?
Yeah, first of all, the market is down from its post-election highs. Second of all, there's other things that matter to the market, like developments in AI. If you think there's things that are going to increase the share of profits going to businesses, for example, more lax regulation, that can also help the market in certain sectors. And finally, they're betting on a lot of these tariffs being dropped. I'm less sure of that.
Jason, how do you think the Fed is looking at this? And you brought that up a moment ago, just in terms of what is exactly how they're looking at the weakening data, maybe how they're looking at tariffs specifically. I guess, do you think it makes it more likely that they're going to act sooner rather than later? And then what does that mean just for the ongoing or potential for multiple cuts here between now and year end?
So there's two conflicting forces here. Higher prices mean you want to raise interest rates. A slower economy means you want to cut interest rates. There's a lot of uncertainty about how much this is a one-time change in the price level versus a change in inflation. I'm not entirely sure what the Fed would do, but at the very least, that level of uncertainty raises the bar on their acting. It makes it the evidentiary threshold to cut interest rates that much higher. And I think that evidentiary threshold is going to be something like the unemployment rate rising to 4.5%. before any more interest rate cuts are in play.
Jason, is that the most important economic indicator to watch? Or I guess what is when we're trying to assess the threat here or the likelihood of an economic downturn?
You want to look at a lot of data, but certainly the unemployment rate, what we're seeing in terms of job growth, those are two of the most timely and accurate measures of the economy. There was GDP now from the Atlanta Fed is showing negative growth. I would discount that quite heavily. I think there's some real flaws in their methodology. So I don't think the economy is turning on a dime in a negative direction, but everything, the uncertainty, sentiment, all of that is pushing towards slowing.
All right, Jason, always great to get your insight. Thanks so much for taking the time to join us.
Thanks for having me.
Yahoo Finance bringing you team coverage across our newsroom of President Trump's tariff fallout. Now we're going to take a look at the auto sector, commodities, and pharmaceuticals. Let's start with automakers. We're seeing a huge move this morning in pre-market trading. You're looking at a move to the upside here. This coming after U.S. Commerce Secretary Howard Lutnick teased an update related to the trade standoff between the U.S., Canada, and Mexico. Madison Mills joining us now with more. And Maddie, the thought of some relief here, enough here to really move a handful of names.
That's exactly right, Seana. Auto stocks rallying this morning as it sounds like car makers could get an exemption from tariffs, clarity that could come as soon as today. Commerce Secretary Howard Lutnick all but confirmed that the three big automakers will receive exemptions from the tariffs on Canada and Mexico. He said, quote, "Our expectation is categories. There will be some categories left out, and it could be autos." He added that the big three say that they produce cars that are compliant under USMCA, implying that USMCA compliant companies could be exempt from these tariffs. Now, these comments come after we just had one report showing that tariffs could increase some car prices by as much as $12,000, leading to a dip in auto stocks. We've already seen used car prices rising as demand for used cars has ticked up ahead of these potential tariffs. So will that inflation remain following these comments? Again, the market seeing this as a win, with companies like GM, Ford, and Stellantis all rallying off of those comments.
All right, Maddie, we'll continue to closely track those in today's session. We also want to turn to commodities. When you take a look at copper prices, they're surging this morning after President Trump last night mentioned imports will be subject to a 25% tariff. Very own Jared Blickery joining us now with the latest move to the upside that we're seeing. Jared.
Thank you, Seana. I think it's instructive that this is the biggest jump for copper, 4.32%, that we have seen since early November of 2022. I'm going to put on a 3-year chart here. And in fact, we're also seeing the highest prices almost since May of last year. But back in 2022, that was when the demand picture for China was changing, and that was because they were ending their zero COVID policy. Markets were looking ahead to the demand picture increasing for copper. Now today, we have a different picture. We have supply concerns. We have elevated prices for copper because of tariffs. So my argument is this is changing the picture for macro components. There are lots of levers here, and the playbook for this year is definitely different than anything we've seen in years past.
All right, Jared, thanks. Finally, we want to move on to the healthcare sector. On top of the existing levies that have been announced on China, Canada, and Mexico, President Trump is also weighing additional tariffs specifically on the pharmaceutical sector. Here at the Closer Look is Anjali Kamlani. Anj.
Yeah, that's right. Quick note on the Mexico part of it. We know that there is an announcement on potential adjustments to that, but Mexico specifically has medical device makers overly exposed to those tariffs. Mexico had flipped in the last several years from a big importer to a big exporter of medical devices, and so that is where it could feel the most pain. We know that companies like Medtronic, Johnson & Johnson, GE Healthcare are among those that could be heavily affected. Meanwhile, the pharma manufacturing situation, Trump announcing potentially next week 25% tariffs on pharmaceutical manufacturers. That is causing some concern about nearshoring that happened over the last several years and potentially having to shift that to onshoring entirely. Pfizer CEO Albert Bourla telling a recent investment conference that they have the capabilities here in the U.S. and the manufacturing sites are operating in good capacity, so they might be able to just transfer manufacturing from outside to inside. That's something that a lot of other companies are looking at. We know that Eli Lilly, for example, just announced $27 billion in raising its manufacturing specifically for key active ingredients. APIs is what they're known as, and that is something that is a major importation product. So that is something that we'll have to keep an eye on.
All right, Anj, thanks so much for breaking that down. Coming up next on a morning brief, we're going to count you down to the opening bell on Wall Street. Futures still falling into the red, at least for the Dow, and actually we're looking at just above the flat line there, flipping as we speak. Crowdstrike plunging following its latest earnings results. We're going to bring you those details ahead. And we'll break down how tariffs are impacting retailers. All that and more coming up on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session. It's all done on Yahoo Finance's trending tickers page. Catalyst co-host Madison Mills here with me to break down some of today's movers. Maddie, so let's do it. First, we're taking a look at Crowdstrike issuing a disappointing outlook for the first quarter. Still, the cybersecurity provider's fourth quarter results topping expectations. Revenue was actually up 25% from a year ago. Now the report coming more than 7 months following a faulty software update that caused a widespread outage. It grounded flights, costed U.S. Fortune 500 companies an estimated $5 billion. When you take a look under the surface at some of the results and obviously some of the guidance here, some of the signaling coming from CrowdStrike, they haven't totally moved past that outage, still dealing with some of the ripple effects of that here. But when you take a look at the magnitude of the drop that we are seeing, we are off the lows of the session, or at least of the morning trade here, pre-market trading off just about 7%. We could possibly be headed for the largest intraday decline that we have seen since going back to that outage at the end of July. But again, Maddie, this brings up some questions just about demand, what exactly that looks like, the ability for their increase in demand to offset the challenges that are still obviously showing or rearing its head just a little bit when it comes to that outage several months ago.
Yeah, and it's interesting to take a look at the guidance as well, which a lot of analysts are, of course, citing this morning. morning talking about how the 2026 guidance is prudent to look at, according to Truist, saying that it remains a cautious approach moving forward because of that July 19th incident. You also have RBC talking about the revenue outlook being in line with expectations, but profitability was below consensus. I think it's interesting, too, just taking a look at the analyst reaction here. You have a price target raise from Raymond James this morning, but it looks like the rest of the movement in terms of analyst ratings is in the form of cuts. You have a cut to the price target from Stifel, and you also have a cut from Mizuho this morning. So interesting to see that Raymond James sticking out with that raise on its price target, but maintaining its outperform rating as well. And I'm just going to actually really quickly take a look at the broader analyst ratings on this stock here to give that broader context here. It looks like you still have 75% of the street's got to buy, about 25% still on hold for Crowdstrike.
Yeah, and it's interesting just to see how many analysts do still, or some of the analysts that do still remain bullish, just their thesis right now. And I was going through the quick reaction from Dan Ives over at Wedbush, and he was saying the initial thought here following that outage was that renewal and new business fallout was going to be huge here. And he was basically saying, putting in perspective, that the bark was a lot worse than the bite, that the gross retention rate does remain at just over 97%. So that's reason enough to be encouraged. So yes, there might be small bumps in the road here as you take a look at the next potentially couple of quarters or couple of months. But again, looking ahead here to the rest of 2025, at least in his view, he's still saying that a lot of this momentum is enough to like at this point.
Absolutely. All
right, let's take a look at Nvidia. Nvidia back in the green this morning following a steep drop earlier this week. Now the move to the downside coming following a broader market uncertainty. You're looking at gains this morning of just about 0.7%. Analysts now tracking the 200-day moving average for signs of more trouble ahead. The stock now trading well below the gauge here. When you take a look at ultimately what this means, what that next test level is going to look like, there are a number of numbers out there here from some of the technical strategists, whether or not that's 113, 110, 90, talking a lot about a range between 103 and 107. But I think one of the key takeaways is just in terms of how fast and how far it has fallen, just the valuation aspect of this. And obviously, NVIDIA's valuation now at the lowest level that we've seen in over a year. So, of course, that begs the question whether or not maybe this could be a buying opportunity. Obviously, that very much up for debate. But again, when you take a look at the degree of the drop, some of those critical levels are really coming into play.
I think it's going to be interesting to see, and I wonder if we can throw up what NVIDIA stock is doing right now pre-market, just because it is interesting to see a couple of these individual sectors moving to the upside off of those comments from Howard Lutnick, talking about the fact that we might see carve-outs and exemptions for specific industries. He was speaking specifically about autos. He did mention clarity on tariffs to come for other sectors, including chips and pharmaceuticals, moving forward to that April 2nd deadline. So I am curious to if we can see the intraday moves on NVIDIA here, what the stock is doing ahead of pre-market, and whether or not we're seeing some relief off of that idea that we could potentially be getting a little bit of positive lift to that stock off of that potential of some tariff relief, though also perhaps just kind of revising after such a significant sell-off. But that 200-day moving average was seen as such a technical level that could potentially lead to even more selling. So at least you're not seeing more of that this morning. If you are an NVIDIA shareholder, that must be a relief.
Yeah, certainly. And hopefully it holds.
Right.
Still very early, and obviously with so much rhetoric coming out of Washington, obviously a very headline-driven market, it seems, as of late, obviously could turn on a dime. But again, we are seeing some relief, I guess you can say, with the stock up just about 0.7% right ahead of the open. Okay, right here on Yahoo Finance, we are just minutes away from the opening bell. We've got that for you when we come back. Here's the opening bell on Wall Street as we do a check of the markets. Stocks trying to see some relief here as investors try to square the latest rhetoric coming out of Washington. Commerce Secretary Howard Lutnick hinting at the fact that we could see some sort of pullback here on some of the tariffs that have been announced on Mexico and Canada here as soon as this afternoon. That, of course, really impacting the broader markets here this morning. But again, you aren't seeing too much movement here from the flat line. You do have the Dow trading just below the flat line. Of course, that comes on the heels of some of the selling pressure that we have seen most recently. Taking a look at today's action, off just about 14 points, so essentially flat. But when you flip it back over to the chart and some of the action that we've seen over the last 3 days, that really really puts in perspective the degree of the selling. You do see the Dow off just about 3% over the last 3 days. And flipping over to the S&P here this morning, you are looking at it trading just above the flat line there. Again, though, well below that 5,800 level as we keep that in mind. And taking a look at the 3-day chart and some of the action that we've seen over the last several days with the S&P, you're also looking at a decline of nearly 3%. We've seen that steady drop there after we broke below that 5,900 level. Taking a look at the NASDAQ, there has been a lot of the selling concentrated, at least earlier in the week, was in big tech. We've seen a bit of a relief here, but whether or not that holds remains to be seen. Over the last 3 days, you're still looking at losses just about 2.7%. The Russell 2000, that's also been under tremendous amount of pressure here. You talk about some of the selling that we've seen in some of those smaller cap names. Russell 2000 so far this week off nearly 4%. I want to flip over some of the action that we're seeing play out in the bond market here. We did see some movement there on the heels of the ADP report that we got out earlier this morning, coming in well below the street's expectations. You are seeing the 10-year yield now, not too much change, up just about, or trading right around 421. Flipping over to the sector action, at least an early look here at today. You are looking at materials, industrials, technology, bucking that downward trend here for the broader market. But again, when you take a look at energy, still under a decent amount of pressure, off just around 1.2%. Also, real estate and utilities now seeing a bit of selling pressure. Let's kick it over to Jared Blickery for a closer look at this movement that we're seeing at the open. Jared.
Thank you, Seana. Let's go back to the indices. I'm noting that the S&P 500 and the NASDAQ are hitting basically at 4-month lows. And I'll show you a 6-month chart so we can see. You draw a line over there, and we're back in November territory. And so that just begs the question, when are we going to see that bounce? S&P 500 critically very near its 200-day moving average, almost touched it yesterday. I'm going to be doing a deep dive into that. What happens when it does that in about 20 minutes? There are some important ramifications for the short and long term. Russell 2000, the small caps, out of the gate, they're up just a little bit. We'll look at the S&P 600, but Russell and the S&P 6 are trading at the lowest levels going back. You'd have to go back to August, I believe, and don't quote me on that, but that's a pretty long way back. We're also seeing some more weakness in the dollar, the Dixie U.S. dollar index, that is down 3 straight days. This is a 6-month chart, and I'll just show you the year to date. And dollar has been very weak this year. It's down 4.25%. That is another ticker that has now traded below its 200-day moving average. So that is just another technical level that we keep seeing violated by indices, the dollar, and all of it seems to be pretty risk off these days. Looking at the sector action, as Seana just noted, energy, the worst sector of the day. I want to put this on a 3-day look so we can see energy now down over 5% for the week. That is a pretty big development for that trade. That is on the back of crude oil, which has been the weakest in months, and S4A has been covering that for us. And I want to go back now to the NASDAQ 100 so we can see what's happening with the Mag 7 trade and kind of a split picture. I'm not seeing a lot of outperformance. Looks like Broadcom just trading above 1%, but for the most part, all the other securities in there, Tesla up 0.7%, nothing up or down more than 1. We saw a lot of strength in chip stocks yesterday. I'll just switch over there just briefly. You can see kind of a mixed board today, but right next door, I got Chinese tech, and that has really caught my eye. That is a sea of green, and that's really interesting on a day when we see those increase copper prices. There is a correlation there, but as I pointed out just about 10 minutes ago, that relationship may be changing, the demand picture versus the supply picture. Nevertheless, I'll show you a 3-day view here. Some of these names up a decent amount over these 3 days. I'm going to close here with Bitcoin, which has seen a tremendous amount of volatility. Currently, it just touched 90,000, just above that $90,000 threshold. It has been a rocky road since Trump announced that strategic crypto reserve on Sunday. First, we got that huge run up, then that huge run down, and now we are right back in the middle. So that just means it's decision time. And I'll throw it back to you there, Seana.
All right, Jared, thanks so much. We want to get to today's strategy session. We have U.S. stocks fluctuating. You are now looking at gains here across the board of the major averages. Now, this comes on the heels of the back-to-back losses that we've seen of more than 1%. And the drop that we saw earlier this week came amid growing concerns surrounding economic growth and also tariffs. So how should you and how can you navigate this increased volatility? Joining us now, we want to bring in Young-Yu Ma. He's BMO Wealth Management's U.S. Chief Investment Officer. We also have Terry Wiseman. He's Macquarie Group's FX and rates strategist. Great to have both of you here. Young-Yu, let me start with you just in terms of some of that uncertainty that we're seeing here, obviously drive a lot of the action. What do you make of some of the selling pressure that we've seen so far this week?
Yeah, thanks, Shauna. It's great to be here. We do think there's just a lot of disruption going on at once. Of course, tariffs, which probably are just midway through at most the program that the administration plans to put on across the globe, but also the disruptions from Doge, which will become increasingly significant, we think, in the coming months, but also the slow moving disruption from AI. We think that's causing some angst among the workforce about job stability. So when all this is coming together at once, we think it's a lot for the markets to digest, and there's probably more fragility in the economy based on recent data points we've seen than was commonly understood and may be understood by the administration. So we do think that it's important to get some type of resolution or walk back to the Canada and Mexico tariffs pretty shortly in terms of being able to at least stabilize the market. We don't think it's going to lead to a durable bounce, but at least some stabilization in the near term.
Terry, what do you think? Do you agree?
I certainly agree that policy uncertainty has been at the crux of the problems that we're seeing with surveys, certainly from the business sector and from the household sector. I think in the case of the business sector, and the reason why sentiment has fallen, let's say in the CEO roundtable or the NFIB surveys, is simply because businesses don't really know and have a lot of uncertainty and cloudiness around the tariff issue. Now, that could be resolved in a few months. Let's hope it is. If it does get resolved, I think most of that policy uncertainty will dissipate. In the case of households, though, I don't think that it is tariffs specifically that are causing sentiment to be weak. I think that has much more to do with the job situation, especially as it pertains to federal contractors that might be let go, or even the technology-induced layoffs. So there are two things going on, and they are obviously weighing on sentiment, and that is translating into a weak market as well.
So then, Terry, how do you assess or maybe navigate some of that policy uncertainty?
Well, one way is simply to stay away. If an investor cannot deal with too much volatility in the market, sometimes the best thing to do is simply to hold cash and wait this out. I don't think that's a bad idea right now. The VIX index is telling us implicitly that there's going to be a lot of volatility in the next few weeks. And that makes perfect sense in an environment that is really saturated with headlines coming out of Washington, headlines coming out of Brussels and Berlin, headlines coming out of Beijing. We've seen headlines from all three places overnight, and that accounts for the whipsawing that we're seeing in these markets.
Young, how are you advising your clients, or where are you finding those opportunities given that macro uncertainty?
Yeah, I think you want to be patient with opportunities here. What look like good opportunities or decent opportunities right now may turn into you may have better opportunities in the coming weeks as some of this disruption plays out and some of the softness that we get in the data probably continues for some time to come. I think we have a timing mismatch here. There are some benefits that we see coming through by mid-year in terms of some of the focus on tax cuts and other elements of the current disruptions will probably be more stabilized with Doge and with tariffs by mid-year. So we think you really have to be patient here. Opportunities will arise. We don't recommend wholesale running away from this market, but we do think people with cash on the sidelines want to look for not just good opportunities, but great opportunities before they deploy some of that. In the meantime, we do think there are some benefits and potential opportunities going on in international markets, China in particular. We've been recommending to clients recently.
Young, how real is that risk of recession at this point?
Well, I think a lot of what's happening now is reversible. And that's what's important to see. Some of the underlying fundamentals remain stable. We think that's the case. And once this period of disruption and maybe even acute disruption gets behind us, or at least largely behind us, we think those fundamentals will reassert themselves. Productivity gains this year will be favorable, and consumer spending and business spending as well can resume and have more confidence that the investments or the spending that's taking place won't be something that they tend to have regret about. So we think that's just going to be a process. So in terms of recession, could we get 2 quarters of negative GDP prints? We could. That's possible. Is there a lasting recession? Do we get a lot of downward momentum? We actually don't see that taking place in terms of downward momentum that lasts throughout the year. So we do think to the extent it happens, you do want to look for opportunities.
Terry, as you look ahead to the jobs report that we're going to be getting out on Friday, obviously we had the weaker than expected ADP print out here this morning. Is there a real risk that we are going to see a further deterioration there? And I guess what does that then tell us about obviously Fed policy and some of the upcoming decisions that we could see?
Well, it's certainly possible that we see some weakening in the labor market. Certainly the surveys that we've seen recently would suggest as much. That households, of course, would not be seeing their sentiment decline unless they felt a modicum of uneasiness with regard to the job outlook. And that could be reflected as early as the February numbers, in part because of what's happening with technology and what's happening with efficiency driven undertakings at businesses. With regard to the Fed, though, it's a bit of a conundrum, right? Because to some extent, a lot of what we're seeing out of Washington could be deemed to be inflationary. Ultimately, something like a tariff is a supply shock. It conceivably can both raise prices and create a wider output gap. And from the perspective of the Fed, that poses a problem. It's not clear that the Fed will want to ease aggressively into a situation where inflation expectations are rising, for example, as they have been recently. At the same time, there might be an imperative to ease in view of the widening output gap and maybe a rise in unemployment rates. I think the best thing you can say, the most certain thing you can say about the Fed going forward is that the kind of policy environment we are in right now is going to create a wider divide, which hasn't existed recently, between people who are on the dovish side of the spectrum and people who are on the hawkish side of the spectrum at the Fed.
All right, well, Terry, a lot to think about. Thanks so much for taking the time to join us. And of course, our thanks to Young Yuma as well. Coming up, American consumers facing rising costs in the wake of new tariffs, from footwear to food. We'll be breaking down what it means for you. That's coming up next on Catalysts. Foot Locker reporting mixed fourth quarter results and warning of promotional pressures this year. Meanwhile, the retailer is just one of several companies that could soon feel the effects of escalating global trade war. Madison Mills has a closer look at that impact. Maddie.
This week, President Trump doubling the tariff on all Chinese imports to 20% after enacting a 10% tariff earlier this year. Those duties are on top of existing tariffs on hundreds of billions of dollars worth of Chinese goods. So the question, what does this mean for a company like Foot Locker? Well, nearly 35% of Foot Locker shipments are imported from China, according to data from market research firm Volza. Now let's take a look at the industry more broadly. The U.S. market for footwear is almost entirely supplied by imports, the largest percentage coming from China. In 2021, China accounted for more than 42% of all U.S. footwear imports, worth $11.5 billion. So what does all of this mean for consumers? Well, tariffs are paid by the U.S. company importing the goods from China. So companies have to decide, are they going to pass on costs to consumers or raise prices to absorb the costs themselves? According to data from Moody's, just a 10% tariff on shoes from China could increase the sticker price for those shoes by about 4%. Seana, back to you.
All right, Maddie, thanks so much. Well, new tariffs imposed on goods from Mexico and Canada are expected to increase prices for Americans across industries, with food expected to be one of the hardest hit. Joining me now, I want to bring in Peter Galbo. He is a BofA Securities food and beverage analyst. And Peter, we want to dive into specific names here, but I think just more broadly speaking, as investors are trying to assess the potential economic impact or the potential impact to themselves here from these tariffs, what does it mean for those within your coverage, and who is most exposed?
Yeah. Hey, Seana, good to be speaking with you again. Look, as these tariffs news came out about a month ago, we really did a pretty deep dive analysis across the coverage, trying to understand, potential positives and negatives, or winners and losers of potential tariff impact. And really what it comes down to, is you're thinking about the food categories, I would kind of characterize it in two big buckets. One being kind of the proteins space, where there's a lot of trade flow that goes back and forth between Mexico, Canada, and the U.S. And the other is going to be produce. Again, think about seasonal items that we maybe source from places like Mexico when growing conditions are not necessarily optimal in the U.S., and kind of vice versa when we're sending, our produce abroad as well. So again, as we think about broader buckets, it's probably those two that are the most exposed.
Peter, what does pricing power look like, just more broadly speaking, across the industry, and the ability at this point to pass along some of those price increases to consumers?
Yeah, no, at this point, look, the consumer has been very full on price probably for the past, 18 to 24 months. And this is a question that we're facing as inflation potentially kind of reaccelerates and you get to a point where these companies are either going to have to look to put in additional pricing or kind of take it on the margin hit. Now, there's a few categories that we're looking at specifically. We call them the 4 C's. So that would be coffee, cocoa for chocolate, cattle, and then chickens, where we've seen the most inflationary pressure. And really, it becomes a question of, for some of these categories that are more pass-through in nature, can the companies look to kind of pass that pricing on? Historically, when the prices come down, they take pricing down. But for other, more stable categories, call it, cereal, more center of the aisle, if there are inflationary pressures, it's going to be tougher to pass on additional price increases.
Peter, one of the names that you cover that was out this morning with earnings is Campbell Soup. You're taking a look at a drop here this morning, pretty substantially in sales. A lot of that having to do with that guidance cut there. I'm curious just your assessment of that softer than expected outlook and maybe what that signals about some of those industry-wide challenges.
Yeah, so look, first quarter for the new CEO out of the gate. So obviously there's a resetting of expectations often that can come with that. I think that, Campbell's continues to face some challenges, as does the broader industry from a snacking perspective. The recovery in snacking, which has historically been such a strong category, just has not kind of come to fruition the way that we all thought it might. As it relates to kind of the core, meals business, look, things are holding up okay. Some of that was probably due to colder weather that we've all been experiencing, particularly in the Northeast over the past few months. Some of it has to do with competitor, issues as it pertains to things like broth, where Campbell's is kind of filling the gap. And some of it is the continuation of the Rao's brand, which they purchased about a year ago at this point, which has still done very well, but the growth is starting to slow. So I think as you look towards the back half of the year for Campbell's, it's a bit of, caution around just some of the headwinds that are known in the meals business, and then maybe a little bit less recovery on the snack side, which is consistent with what we've heard out of PepsiCo, out of Utz, out of the other salty snack manufacturers that we cover.
Peter, tariffs were not included, right, in the guidance that was issued this morning. How big of a risk is that to the company?
Yeah, and it was asked on the call. It's tough to dimension exactly what the impact would be, but just as we've thought about some of the figures, as we've gone back through it, it's really two things. One is tin plate steel. So think about food cans. Campbell's, buys a lot of tin plate steel from Canada used to make cans for soup. And the other piece of that is going to be cooking oils, things like canola oil that get imported from Canada that you get used in the process of making late July chips and kettle chips. So tough at this point from a quantitative impact, but at least we have some of the qualitative pieces.
And Peter, when you talk about the modeling that you're doing in regards to tariffs, just given all of that uncertainty, I guess how should investors then be looking for those opportunities as they're trying to either get their portfolio a little bit more defensively positioned or trying to hedge against some of that risk that we've been talking about?
Yeah, look, Seana, it's still a moving target at this point, and what we've tried to lay out for our investors has at least been the exposures where we know, whether that be a lot of food companies that are selling into Canada, so we at least have an idea around the exposures there. Some of this is around supply chain, and again, it gets tough to get nitty-gritty on the numbers, but we have at least qualitative concepts of where the supply chain is flowing from. And so as we've laid that out, look, it's a challenge for a number of companies who are producing in Mexico and moving into the U.S. But ultimately, again, this is a moving target that, seems to move day by day.
It certainly does. All right, Peter, always great to talk to you. Thanks.
Thanks so much.
Keep right here on Yahoo Finance. We got much more of your market action ahead. You're looking at gains across the board. Slightly, actually, you have the Nasdaq now just below the flat line, but the Dow at least up just about 0.4%. We'll be right back.
Only weeks after touching a record high, the S&P 500, it has turned red on the year. Now a key technical level is coming into focus. The index may be headed for more short-term pain if history is any guide. I'm Jared Blickery, host of Stocks in Translation, and today we're looking at the 200-day moving average. Now, a simple definition here. It smooths a stock's price over 200 trading days, helping to identify long-term trends, and it could be 200 weeks, it could be 200 years if we are lucky enough to live that long. But I want to show you what the S&P 500 in relation to its 200-day moving average looks like over the prior 3 years. And I think this is instructive because in 2022, that's where we began in the early part of the year. You can see the price was below it, and that was a key indication that we were still in a bear market. Then it started poking above in early 2023, indicating confirmation of the new upward trend, and we touched it a few times. We even came below in late 2023, so it can be violated and we can see resumption of the uptrend. But I did look up in history, and this was pretty interesting. I looked at all the times in history when the S&P 500 bounced off of its 200-day moving average, came within 0.5% of it, in other words, and then what was the performance 1 week later, 1 month later, 1 quarter, etc. Well, I have that right here. It has happened 16 times in the history that I have, going back to the early 1960s. So there's not a lot of sample size there, but we do have negative performance over 1 week and 1 month. And I think that's pretty interesting. The percent positive performance is only 38% and 31% for 1 week and 1 month. That is very low. So the short-term outlook, just based on history, is actually a bit negative. Then things pick up after a quarter, 81% positive with median gains of about 3.6%. And then if you look at 6 months or 1 year down the road, things pick up again in terms of median return, although the percent positive drops a little bit. And there are some big years in there that cause problems on these longer-term timeframes. One of those was 2007. We got a signal then. Guess what happened? The global financial crisis. We also got one in 2015, and we had a bear market by many indications in that time window. So bad things can happen. Now, there's also the flip side of that. In 2018, that was the last time we got this signal. That was the February Volmageddon episode. That was kind of a one-off. We saw a quick decline to the 200-day moving average, then it was off to the races again. So you put it all together, I think we're in for a little bit of short-term pain. Things tend to resolve on the longer time frames because stocks tend to go up, but I do think we have some caution flags for this year. Tune into Stocks in Translation for more market decoding deep dives, new episodes on Tuesday and Thursdays on Yahoo Finance's website or wherever you find your podcast. Seana?
All right, Jared, thanks. Keep it right here on Yahoo Finance. Coming up next is Catalyst, much more analysis on the biggest drivers of today's market action. You've got the stocks off their highs of this session. We'll be right back.